Buy the dip or sell the news. Hello, I'm Michael Smith, and welcome to the Lowdown. Hello, everybody. Joining me today is Kevin Lennox. And Kevin, you normally come on once a month. We talk about what's happening. But in light of what happened last week on Friday and obviously Monday of this week, I just thought I'd ask you what the heck happened, if you could just to kind of explain to everybody. But it seemed like right after we aired the show or taped the show, it seemed like everything just kind of unfolded. So I thought I'd bring you back in this week and you can tell everybody what exactly happened.
Yeah, we taped the show just after the Fed announcement, before the press conference, and yeah, all hell broke loose afterwards.
It sure did.
So in our view, the biggest thing that happened was this disorganized unwinding of what was called the yen carry trade.
Okay.
So in Japan, they have had interest rates negative for years. They finally went to just even, or rather zero rates in March. And then on July 31st, they went to their first 25 basis point increase in rates.
Okay.
And for a long time, this yen carry, where investors, particularly in Japan, but also some U.S. hedge funds as well, would borrow money in yen and then buy investments that they think could do very well in a stronger currency. And the difference is called the carry. So a lot of this was done on leverage as well.
So leverage being the key.
So when the Bank of Japan had this surprise announcement that they were raising rates, then investors got caught wrong-footed, and it's in essence a margin call.
Okay.
And we have speculated, as many have, that a lot of those investments were in U.S. tech stocks and CLOs on the credit side, which are collateralized loan obligations, which are packages of corporate loans.
So typically in a margin call, you're not selling something because you don't like it. You're selling what you need to sell to raise the money to meet the call.
You're selling what you can.
Exactly.
That's liquid.
Yes.
And guess what's liquid? S&P 500 stocks, and in particular, the large tech stocks.
How big is the carry trade? Can you give us a number, just to give us some example there?
It's unknown.
It's unknown. Okay.
But Deutsche Bank has come out with a number about 20 trillion.
That's quite large.
Now, you don't know the risk tolerance. You don't know the degree of leverage. So you don't know how much unwinds. But when things start to unwind, there are investors that have to get out. And they think if they think they all own these tech stocks, then they're like, I better sell before the guy that is forced to does. And it just became this unraveling that happened on a Thursday, Friday in July, which is the height of vacation season in New York. A lot of trading desks are thinly staffed.
They're all in Europe.
And then you see that NVIDIA's new AI chip is going to be delayed for 3 months. Oh, well, that directly affects Meta, Microsoft, and Google. Again, big tech stocks.
Sure.
And then Buffett sells over half of his Apple stock.
Yep.
So all this hits after our
So it's just like this giant domino effect. Well, so I guess the question, obviously, that was Friday that carried through to Monday. It's usually unusual to see it carry through the weekend, but there was no jawboning about it at all. And then Monday was pretty vicious. Well, let me ask you this: is that yen carry trade unwind? Is that done to the most degree? Do we know? What do you feel like is this a continuation about to happen?
We don't know.
Okay.
And I don't think anybody really does. The ISM Institute of Supply Management survey of service business came out Monday.
Okay.
That was a surprise to the upside as far as activity, new orders, also employment showed growth. So that was a big positive. And then the Bank of Japan very publicly fell on their sword and said, sorry.
Sorry for all the news. That was good.
We will not again try to raise interest rates when markets are unstable.
Yeah.
Which they're going to cause instability anytime they
Well,
do it, so they may not do it again.
Well, when you've done something, to your point at the beginning, you've done something for 30 years. I mean, I just think about that is a long time, especially in any trading investing world. Typically, it's hard enough for investors to think past a year. They think 10 years. 10 years is what we normally tell people, but 30 years of doing something. And then the unwind of that, of course, that's going to be pretty massive.
It is. So the big thing that we're looking at is financial conditions, which is basically the credit markets and the volatility of markets, which impacts the degree of leverage or risk-taking you can do in a portfolio. So to this point, stock market volatility went from 15, 20 to 60 at one point. Credit volatility also spiked. The good news, at least to this point, is we have not seen the short-term funding markets seize up. Haven't seen the credit markets. High yield is still okay.
Yeah.
I think private credit could be in for a surprise. I mentioned the CLOs.
Sure.
So private credit, and I've said for a long time, not a long time, but a couple of years, I think we could see some private credit managers unwittingly become private equity managers.
Sure.
But so that's an area to watch. So financial conditions have a direct impact on the economy. So if they stay stable, aside from the volatility eventually calms down, then I think the soft landing scenario can still play, have a decent role of playing out. If things tighten, if things broaden, if banks and other credit firms shut off credit, then you're going to see a spike in unemployment. And we talked about the sensitivity of the leveraged loan companies and the high yield companies to higher rates or tighter lending conditions. That could cause the jump in unemployment. So it's too early to tell, but that's what we're watching.
Sure.
On the equity side, within the beast of the equity market, a huge rotation, as expected, from cyclical companies to defensive companies.
Yeah.
The XLP, which is the consumer staples ETF, just printed a 52-week high.
Okay. Yeah.
So you see that. We would like
shift.
to see a rotation back towards cyclicals, which had been handily outperforming defensives for most of the year.
Well, I guess something to support maybe the glide path landing or the softer landing. It's something we've talked about a long time, and it's liquidity is what matters, right? Yeah. And so we had been seeing kind of that lack of liquidity, and the conditions tightened for that. But now you've seen, I don't know if you've seen, but global M2 is definitely ticked higher. So we're potentially seeing some liquidity kind of re-enter. So that might support kind of a softer landing. But I do agree, if this yen carry trade gets a little bit ahead of anyone's skis, or the unknown becomes more known and it's not great, then we could see again some tightening, and that would be bad. So I think it's a wait and see game at this point.
On the labor side of it, the non-farm payroll report also came out Friday.
Okay, yeah.
And that was weaker than expected. And we did talk about that last week, that it could be a softer print attributed to Hurricane Beryl.
Yeah.
And I did see where about 70% of the unemployment uptick in unemployment was considered temporary.
Yeah.
That's not the same as a permanent layoff.
Permanent is a big deal.
Never put too much effort into one, particularly a government report like non-farm payroll.
Well, true.
Which is inherently volatile. And they did decrease the job growth for each of the past 2 months. Mm-hmm. Not really unexpected. That's been taking place basically all year.
Yeah. Well, remember the seasonality of jobs in the summer as well.
Yeah.
We're coming to the end of that. People are getting back to school and et cetera. So that you're going to see a drop in that as well.
And then the unemployment rate ticked up.
Yes.
And then the people started quoting about the SOM rule.
Well, okay. So let's talk about that, because the one thing I've seen, you got 2 days of volatility. By the way, normal markets have several 5% plus sell-offs in a given year. That is what the standard's been in throughout history. Of course, we with the Fed coming in to the rescue, as we've seen in the past, we've gotten a little bit complacent as investors, and now we get 2 days of a sell-off, and I know it was pretty vicious, but it's like anyone that's ever had a recession signal either named after them or somewhat associated with them, they've all come out, and here's their day in glory, and they're all trying to tell you about their one signal and how because this triggered, it's now indicated a recession. But I think with all the things that have changed in the world, in terms of, look at AI, look at liquidity, look at all the things that have just changed over time. I don't know if we can rely, especially after a pandemic, I don't know if we can rely on just one signal. I think we have to take a signal. Okay, great, look at it, but we got to analyze it with other things. But as you mentioned, Claudia Sahm, she's got a signal that came out. It was triggered here. Can you explain that and what that means, and what are your thoughts on that?
We have some questions about the sum rule.
Okay, all right.
So the definition is when the 3-month moving average of unemployment is 0.5% higher than the lowest 3-month moving average over the past 12 months. So that triggered. It's designed to reflect a decline in the demand for labor.
Okay.
But it doesn't take into account a huge influx of immigration. Immigration,
yeah.
So never put all your eggs in one basket. Anybody, as long as we've been in the business, there is no one indicator.
No.
Inversion of the yield curve has a long lag. We've talked about that for 2 years now?
Yeah.
And not a great way to manage money based on that.
Absolutely. Well, so we've got 2 CPIs coming up and one payroll report before the September meeting. And I know you've seen this. I'm sure everybody's seen that a lot of the noise is the Fed's going to cut 50 basis points. No, they're going to cut 75. No, they're going to do an intermittent cut and then another one. Where do you see the Fed basically going? I'm seeing they're pivoting a little bit towards concerns of the labor market, but talk to me about what do you think is going to be the concern of that September meeting or the discussions on that?
Yeah, so I don't think they know what they're going to do yet. Well, they will cut. I mean,
Jerome
Powell said,
yes.
Basically expect 25 basis points in September. I think the overwhelming majority now think there'll be at least 50 basis points. And coming into Monday morning, some were talking about an emergency meeting.
That's exactly
50 basis points. So I think it's too early to say. Again, never put too much emphasis on one report.
Sure.
Granted, the labor market, has been weakening, but bear in mind it's been weakening from a very strong level, with very high levels of wage growth. So it's coming down. Does it come down? It's approaching more of, I think, a normal balance. We'll see if it goes further than that. And the one thing you looked at then is, financial conditions, which then can by itself create this negative feedback loop, which can cause a recession. But in which case, then the Fed, as we know, would step in very quickly.
Well, I'm glad the Fed did not do an emergency cut. I mean, talking about signaling, you don't know what's going on to the market, and the market doesn't like what? Uncertainty, right? So I'm glad they didn't do that. I think there's a lot of time between now and the September meeting that the Fed can get their arms around what's really happening. And saying Wayne Gretzky saying that it was reminded of today is we got to stop being reactive. And I think the last the big sell-off that we had end of last week and this week, everyone's emotions and reactions coming out. You got to stop being reactive to portfolio management. And Wayne Gretzky says is not don't go with the puck, go where the puck is going. And that's what we got to look at, all these data points, all these signal. What are they telling us? How reliable are they? And then where do we need to be positioned? Where is that puck going? So I think that's a much better way to think of things than being the overreactive. And of course, there's plenty of noise out there to get you to do some what I call dumb things in a portfolio.
And most people will trade too emotional. A lot of professionals will do that as well.
Yeah.
And so to bring back kind of the that business cycle perspective, have we seen enough convincing evidence to this point to suggest we're going from the late stage of the business cycle to recession? I would say not at this point.
No.
It's another growth scare. Yes. Will it have legs? Potentially. But we don't know that at this point. So again, the value of having a financial plan.
There you go.
If you know how just how strong your plan is, it's much better to get through a period like this where emotions are higher. And this wasn't even a correction.
No.
S&P only went down to like 8.5%. A correction is 10%.
Yes.
Bear market is 20%. So this isn't much yet. I think the S&P is still up 11, 12% on the year.
Well, that just goes to show you how complacent when you have markets doing well for a good period of time, everything seems to go higher. People forget about what you just said, what a normal correction looks like, and then of course, people are taunting that we're in a bear market. No, we're not down 20%. Maybe some positions were down, but obviously if you're diversified, you shouldn't be down to that degree.
And something we talked about 2 months ago was know what's in your portfolio.
Yes.
And we specifically said, within your portfolio, know how much exposure you have to the big tech stocks, to the growth part of the markets. And I saw it again with a friend that said, I'm down like 18%. Suddenly, I'm like, well, okay, I think I know what you had. And the big tech stock, just growth overall, was down like 14, 15% from the high. And he didn't show me his portfolio, but I'm pretty sure he probably had, he talked about having 8, 10 different funds. And I'm guessing that the top 10 had a lot of the same names in them.
Well, during the height of the Roman Empire, it wasn't the Roman emperor that was the richest. It was actually the strategist named Seneca. And one of the things he always said is know your downside. So, good advice, Kevin. It's long-standing good advice. So thanks for joining us today. And we'll be talking to you here pretty soon.